Welcome back. Thank you so very much for being here. Welcome to another Meet Kevin Report. We are on episode 96. Today we've got quite a few things to pay attention to, specifically data releases. I'd like to pay attention to not just what's happening in Europe with inflation. For example, Germany's inflation reports are going to be coming out in probably about 39 minutes. We should be getting some European inflation and specifically German data. So far, we've got some leading data from some of the states within Europe. That's going to be like North Rhine-Westphalia. That's actually where I was born. That particular state is reporting inflation, has already reported preliminary inflation that's actually falling more rapidly than people had expected for European inflation. So we'll see if that ends up being consistent with the state-wide or the countrywide inflation reports, along with inflation reports from France. So a lot of anticipation over European inflation, especially since now we see them in recession. It'd be nice to know, okay, is this recession actually going to slow down inflation? At the same time, you are just within 2 weeks here of United States inflation data. In fact, 2 weeks on the day today, we'll be getting U.S. Inflation data. Followed immediately by the Federal Reserve either pausing or hiking, which is going to seems to be a coin toss at this point. So let's take a listen in over here and see what's getting chatted up right now, and then we'll get through some data together, although it looks like they may be going to break right now, so maybe we'll hold on, jumping over here. A lot of talk about the slowdown in China contributing to the commodities cycle, and how potentially the commodities cycle has somewhat of a reason to be down, but maybe there'll be some bullishness coming. So I thought this comment was interesting. So they basically suggest for commodities, that is, when I say that, I should say Wall Street. Wall Street is basically suggesting that when it comes to commodities, good luck expecting a rally until you see the Fed running the money printer again, which I thought was interesting because that's what pretty much everybody said about tech stocks, except now tech stocks are winning and everything else is not, which is also kind of frustrating, because then if you're looking for, all right, well, where's value? Where are the good valuations? You might be looking at companies like Intel, which you think would be a tech company, but it's stuck in the mud. Then you look at maybe a company like, an Etsy or Dave & Buster's, like we reviewed yesterday in the Course Member live stream. And you're like, wow, some of these valuations are actually not terrible. But all of those sectors are just getting smashed right now. Nobody cares about consumer discretionary because everybody still thinks you're going into a recession. So that'll be quite interesting to see how the potential recession ends up playing out. We've also got this masterpiece, which I wanted to cover a little bit from the Fed, reviewing some of, I see no reason for a pause yet. That's fine, Loretta Mester. But what'll be quite interesting, especially along the lines of what the Fed thinks, is what the JOLTS data ends up reporting today. So we have the JOLTS data coming out in about an hour and 5 minutes. So it's going to be a little minute here before we get the data. But in about an hour and 5 minutes, we'll get JOLTS. JOLTS is, of course, the job openings and labor turnover survey. And it's useful because it gives us some leading indicators potentially of inflationary pressures from the wage sector. We want to see those slow down and calm down a little bit, because if we can get those to calm down, then maybe we have to be less worried about service sector inflation, which is very sensitive to what interest to what tightness in the labor market is doing. So if you have a very, very tight labor market, you would expect to see more service-based inflation. Now, so far, at least leading indicators based on companies are showing us suggest we really don't need to be worried. Leading indicators aren't suggesting hyperinflation, and sure, there are always going to be hot spots, much like after a fire. There are always going to be little hot spots here or there, and those are always going to be things that firefighters and bears want to pay attention to, of course. Here we go. But I don't think they're a sign of sort of a new forest fire, if you will. But we shall see. So we'll get that data again in about an hour here. So let's see what else we have here. Now what we are going to do is we're going to jump on over here and we're going to listen in before we cover some of the other stuff we want to talk about. Here we go.
In 1996?
Oh, it's still in ad mode?
The answer, the Atari Jaguar.
Ooh, look at that. Now they're doing quizzes in the morning because they're running out of things to talk about. Really?
This morning's pre-market movers. Frank, what are you seeing?
Hey, good morning, Becky. We're going to start off with some earnings movers with just a twist of AI here. We're talking Hewlett-Packard Enterprises and HP Inc. Let's start with HPE. This is a software company. Big miss on revenue, about 5% below estimates, but a beat on EPS and a guidance raise. Important to note, its AI-focused segment beat expectations. I spoke with CEO Antonio Neri. He expects demand for scalable AI to be a big tailwind in coming quarters. All right, coming over to HP Inc. This is a hardware PC maker. Shares down more than 5%. Also a revenue miss and an EPS beat. PC sales were below estimates. Also spoke with CEO Enrique Lores, who expects a second-half sales boost, and he adds that HP Inc. is working with other tech companies to create AI-enabled PCs, something that he believes will be a refresh of the industry, his words. All right, you guys were talking oil earlier today. We're looking at Chevron right now. Chevron shares actually reversing. They were fractionally higher, now down about 1.5%. This after a JP Morgan upgrade ahead of its annual shareholder meeting. As WTI falls below $70 a barrel today, analysts say OPEC Plus, that meets next week, and the SPR repurchase could both support crude prices in a downturn. JPM adds the valuation is attractive at 11 times forward earnings. Again, shares are down 1.5%. And then last but not least, we have another stock that's reversing course this morning, C3 AI. As you can see, down more than 5% right now. Was up big earlier today and up big yesterday. Earnings after the bell today. It was up big yesterday after that announcement that C3 Generative AI is available on the Amazon Web Services marketplace. According to the release, it will allow organizations to quickly and easily use large language models and GPT. As you can see over here, shares of C3 AI rising about 270% year to date, but up over 100% in the last year. Back over to you.
Okay, Frank, thank you.
Thank you.
Joe, you want to say anything else about it?
I really hate to say it. I just despise C3 AI. It's not because you missed the rally on it. It's meme stocking. I fundamentally dislike it. And I'll explain why. This does not mean you can't trade it. This doesn't mean it's not something that, is something you could make money on. In fact, you know what? Please make money on it. I would just highly caution you with C3 AI. Now, we do have earnings coming out on it today, but let's just do a brief look at C3 AI and think about what C3 AI does. Now, this is the kind of analysis that we regularly love doing. And this is just, we're going to keep this very basic, though, so we don't waste anyone's time here. We want to be very, very simple about this. We don't want to confuse anyone, but take a look at this. If you go to the C3 AI website, it looks very nice. It talks about enterprise AI. In fact, if you type into Google AI stock, what comes up is C3 AI. They got the ticker. They got the ticker AI. And so then I wonder, okay, cool. So what kind of products and softwares do you all really have that potentially are unique for you? So we as a group, we just simply looked at C3 AI applications. And one of the first things I thought of is, okay, well, we've got a customer resource manager. Well, customer resource manager, much like what Salesforce has, is relatively simple to deploy. Anybody can create a customer resource manager with a spreadsheet. And one of the concerns I had is with the hundreds to thousands of new plugins now available for customer resource management using AI, what benefit would C3 AI have selling this to enterprise clients? Then I had a similar thesis about some of their software programs for either whether it was ESG or their analytics software, and some of these programs that they're offering just openly on their website. I thought to myself, after the launch of, quite frankly, GPT, you now have no code drag and drop data sets where you can use AI to create your own data set pretty instantaneously using these no code AI apps. And what was bizarre was those no code AI apps that are pretty much free on the internet now, or maybe they cost you $5 or $10 a month. C3 AI is trying to charge enterprise clients thousands to tens of thousands to hundreds of thousands of dollars for them. And while that might be great for some period going forward, I'm really concerned that their ability to actually sell enterprise AI is going to be relatively limited going forward, mostly because I think enterprises may be excited about AI, especially existing customers right now. But in the longer term, in the future, I'm worried that a company like C3 AI might not necessarily have a big moat with some of the software stack that they're selling. And maybe the best thing for them to do would actually be to dump some shares ASAP. In other words, raise some money and create some real products ASAP. That's just my take. And maybe I'm wrong, but at least just browsing around their products, their videos, and what they offer enterprise clients, it seems to me like a lot of it is going to be at risk from the chatbots that were created. And, well, that's a problem. Now, another thing that I did is I jumped on over to their balance sheet. And let's go take a look at this. So this is their, let's see what we have here. This is their last press release. They actually didn't really provide many financials in their last press release. Let's go to their Q3 SEC filing then, and then we're going to get a little bit more detail. So what we have is right here. We have about $800 million on the balance sheet with about $60 million in bills. So you actually have a pretty decently strong balance sheet, which is fantastic. It's the revenue statement here. Let's go to cash flow statement. You've got a net loss of about $203 million. You've got operating activities generating about 142 in losses for the company. And then we've jumped over here to plant, property, and equipment. You're spending another about 60. So you've got negative free cash flow here of about negative 200 million bucks. And this would be in a 9-month period. So every 3 months, the company is, let's see if we divide that by 3, is burning about $66 million. So you've got the extra balance sheet room to do that for maybe about 10 quarters or so. So you've got about a couple years of run rate here, which isn't horrible. But I suspect if they really wanted to keep up this revenue, which, take a look at this, didn't grow at all. It was completely flat between 2022 and 2023, which is a big red flag for a software company that's cash flow negative and free cash flow negative, right? We look over here and we go flat revenue between 2022 and 2023. And on top of that, their professional services generated less revenue. So their total revenue actually went negative year over year. Their gross profit went negative to the tune of about $8 million compared to last year. And then their loss from operations almost doubled. So you have a company that had its loss double. They're burning money. Yes, they have extra money on the balance sheet, but their revenue was already flat to negative, going into 2023. Now, yeah, there's this hopium that, but they're an AI company, so they're going to be the beneficiary of a massive amount of AI spend, right? Maybe, if they can't be replaced by the chatbots. So this is why we wrote down on the right here, what do they have? They have Visual Code Studio. You can just look up Stack AI, for example. There's a Visual Code Studio for you. That's one of the things that they brag about at C3 AI is selling to enterprise clients. And I'm like, you could be replaced by like a $5 app right now, which I don't know. I haven't used obviously the C3 AI program. So maybe, just maybe, these legacy companies like Shell and Koch Industries and Baker Hughes and Exxon and Dow, maybe, just maybe, these companies are going to end up continuing to spend money because they can't figure out AI themselves, and maybe they certainly can't figure out ChatGPT themselves. But one of the other risk factors that I saw with C3 AI was they actually have a massive concentration of revenue coming from basically one client. Look at this. I went over here to the related parties transaction section of their last earnings report on page 27. And what you could find is the following. The company and Baker Hughes revised an agreement in October 2021 to extend the term by an additional year for a total of 6 years for their contract with an expiration date in 2025. And so basically, this company is going to contribute $85 million to C3AI's revenue in 2023. But what's remarkable is if you look over here, this is the revenue that's been recognized so far. $29 million in the first 3 months of 2023. And when I saw that, and 24.6 of last year, and when I saw that, I'm like, wait a second, $28.9 million in the first 3 months of 2023. Wait a minute, how much money did you actually make so far in 2023? 66.6. Wait a second. So somewhere around 40 to 45% of C3AI's revenue is coming from just one party, just one company, Baker Hughes. And if Baker Hughes is like, wait a sec, let's take the L on these commitments here and start using ChatGPT, 40 to 45% of this of C3AI's revenue could just vanish. Now, I know you can't just take an L on a contract. You know, there are reason companies sign contracts and commitments so other companies can plan. But the point is, one entity not renewing at C3AI could sandbag 40 to 45% of their revenue. So that makes me concerned that you've got this money-losing company with a massive revenue concentration. All of these companies, oh yeah, it says non-cancelable revenue commitments, worth noting. All of these companies are that seem to be listed here are, dare I say, relatively legacy companies. You know, what they had talked about with Shell or otherwise. These are relatively older companies, a lot of oil-related companies, energy-related companies, or staple-related companies. And yes, now they are participating with AWS and Google Cloud or whatever to sort of facilitate providing a service. We know that. But it seems like their big customers are in these sort of legacy industries. And I think it remains to be seen what ChatGPT and Bard and some of these other APIs and startups can do to really disrupt a company like C3AI. And see, I'm studying this on a daily basis, especially with my team, because we have the How to Make More Money and Get SH9T Done Faster a course, which is the income course, separate from like the stocks, the investing courses on real estate or stocks. And on just a daily basis, we're looking at how can we be more productive and useful using AI. And the options are pretty incredible out there to where why would you buy some of these products from these enterprise companies where they're charging you an arm and a leg, where really what just happened is you just went through a moment where, dare I say, AI has been democratized for everybody rather than having to be an enterprise client to use these enterprise levels of software. So I couldn't help myself, but I wrote down that this is a company that's basically selling for 9.4 times sales. You're selling at a pretty penny. You don't have earnings, and you don't have really what I believe would be a defendable moat other than legacy income from commitments that you had and companies that might not renew if they can get a cheaper option or potentially even a better option thanks to the new innovation that we've seen in just the last few months here. And so that makes me very nervous about software companies. I think C3AI would be very smart to quickly raise some capital, sell some stocks, sell some convertible bonds, whatever. Like, take advantage of the fact that the stock is run really well and dump some money so maybe you can actually create a real product. But again, this is all just my opinion. Maybe I'm wrong about C3AI. Maybe, just maybe, they actually have some kind of moat it would just end up being one that I couldn't end up finding anywhere. So we'll see. But that's my take on C3AI. Not very bullish on C3AI. We'll put it that way. All right, let's listen. What is this talk over here?
But your regulatory window could be X years, and X could be 5 or 6 or 7 years, and you're carrying the land. It's not that great of a return on investment.
Yeah, and look, we have very nimble capital markets, incredibly nimble capital markets. We actually have a regulatory state that is getting less and less nimble, whether it's mergers, whether it's permitting for energy, whether it's housing, and those two don't match up. That's part of our problem.
So we're at this, going back to our problem that's staring us in the face. We're at what, 120, 130% debt to GDP. Never been here before.
Yep.
Interest rates going up. Nestor just said they're going more, and they probably are. So I'm trying to figure out how much that's going to cost for debt service, and what that leaves us to be able to spend for the growth that you both say we need. It doesn't leave a lot for growth. So we still got problems, and no one will touch entitlements, and the political picture isn't improving in terms of the two sides that much, or the divisions in the country. Is anyone ever going to touch entitlements? What do we do?
And Joe, it gets substantially worse. And I'm not trying to be dramatic here.
I mean, if you were at Goldman and this was a company, if you were back in your old, you'd be like, oh my God, I either get out of the stock, or I don't even want to represent these guys.
But the last piece of the puzzle that we have to start recognizing is the Social Security Trust Fund. The Social Security Trust Fund is in its last 10 years or less of being funded, which means we're going to have automatic decline in funding in payments to Social Security recipients.
I changed the title just like somebody here recommended. Change the title to "The Bubble Is Back." I did it.
Because then he gives cover to, the Democrats don't want to touch him. Now,
we've had no president that has really helped with entitlements in the modern era. At the end of the day, your job as president or as a congressional leader is to get reelected. It's very difficult to take things away from the general population and then say, please support me and vote for me. That said, the calculus to get reelected and the calculus to run a financially responsible country, the intersection of that may be the null set.
You know how we still hear that socialism is the way to go. We just haven't done it right yet. But, next time it might not kill 100 million people. It might actually work. Might be a good deal.
I'll take the other side of that.
Yeah, I'll take the other side of that too. But also MMT. I've got people still telling me that the dollar is the reserve currency of the world, and that no other currency comes close. So we have the ability to print as much as we want, and it's never going to. We can print prosperity. We still have that. People that, and pretty respectful. Stephanie, whatever, Kelton, whatever. I mean, I've seen this posited that MMT will work. We just haven't done it right.
Like I said, I'll take the other side of that. Yeah. But going back to your credit point, it's not just the refinancing, it's the provision of new credit. Because when people are pulling back on credit, it goes to both places, which again is going to have an impact on growth. If banks are pulling back, how are you going to generate growth?
Well, that's an issue too. So are you optimistic about the American dream?
Well, look, I'm optimistic that we actually had this debate.
Yep.
Like Gary said, for the last 3 months, we've been talking about what's going to happen here. And we've actually had a real conversation around these issues. And the American people stepped up. That's
so
why
McCarthy is stronger or weaker after all this?
I think he's stronger.
And you don't see a challenge?
So here.
All right, we'll pull off this here. So we're going to look at American Airlines as well here, at least just some of the items that just came in. Let's see here. American Airlines did just report. It looks like they're rising at the moment, doing quite well. Let's see here. You've got EPS coming in at 145 to 165. They were expecting 132, so they beat on adjusted EPS guide. For the year, they came in a little low on the midpoint. Ooh, that's actually interesting. Let's look at this a little bit more in detail. And also here, there's a comment about certain business. Okay, so here's a comment. This is reasonable at this point. That'll change in the future, and then we can get into American Airlines here. But this is a reasonable comment here for now that really to translate this, it's sort of like if you've got multiple aspects that you need to feed into AI, it's somewhat difficult to just use a chatbot to do that right now, unless you want to consistently remind a chatbot about all of the things that you've previously told it, and you don't have a way to feed it consolidated data. I agree with that, but I believe that will change very, very soon. I don't think we're very far away from having a very simple way to do that and sort of pick up conversations where you left off, where you're not constantly trying to re-explain things to the chat bots. So regarding American Airlines, but yeah, thank you for that. It's a good point. Regarding American Airlines has, let's see here, American Airlines gains 2.5% after boosting second quarter profit outlook. Adjusted operating margins view to 12.5 to 14.5%. That's up about 1.5% on both ends of the range. Continue to see strength in demand environment. Unit revenue driven by continued strength in demand. 2023 Q2 revenue per available seat mile down about 1 to 3% per year. Now that's interesting. American Airlines sees Q2 revenue per available seat mile down about 1 to 3% year over year. Okay. Average fuel prices about 10 cents lower than expected. They see capacity slightly up in Q2, more up in 2023 in total. So more people flying, but it looks like, why would you have revenue per available seat mile down? That's interesting. It seems like you're getting some potential downward pressure there on pricing, whether that means the airlines are becoming a little bit more competitive, or the airlines just want to make sure their planes are full. But that I find interesting. A revenue per available seat mile down 1 to 3%. That's a great thing from an inflation point of view. That I do like to hear. Let's see if we can see the American Airlines press release. So AAL press release. Let's grab that. Get a little bit more detail of what's going on with American Airlines. So especially if it could give us any kind of hints for inflation. That's always important. That's one of the reasons I really enjoy looking at earnings as well. Is I feel like they're a little bit of a cheat code for trying to figure out, hey, what's actually going on in the economy, rather than waiting for these crazy reports that have such volatility to them. At least when you're listening to executives or press releases, like, okay, it seems like we're trending in a direction. That I find very useful. It's like, okay, yeah, we're going in a direction of more labor availability and less wage pressures. Great. That kind of stuff I like. I can get behind. Lower prices for American Airlines, year over year for airfares. That I can get behind as well. It's fantastic. So, unfortunately, they do not actually have their financial results on their website just yet. So we'll have to wait to get their actual full press release. But at least for now, let's see. American Airlines raises second quarter adjusted profit outlook. Forecast lifts shares of peers. Yep. It seems like an optimistic outlook, while at the same time, like optimistic outlook for profitability, but at the same time suggesting they're potentially going to make less money. At least per seat mile. So I guess another way you could potentially look at that is this revenue per seat mile. Maybe people are changing the way they're flying. In other words, you're going with maybe more long haul flights rather than short ones, and that potentially lowers your revenue per mile. But that would imply some form of larger or longer term change in what's actually happening at the airlines. And I'm not sure about that. Oh, well, I guess we'll find out when we actually get the statements from them. But those are not out just yet. Okay, so what else do we have to talk about? Well, the next thing, remember, we got the JOLTS data in 40 minutes. In 10 minutes, we're going to get European inflation. So let's see here. Let's make sure we have that handy. AutoZone reported as well. We can take a peek at that. But what'll be great is let's get the European data ready, because there's going to be lots to talk about with the European data. And then we can know, how is their inflation doing? All right, let's see. There we go. All right. In the meantime, let's listen in over here while I pull this up.
Business district office space. It is significant. It was the flagship trophy properties, and these buildings are still largely empty in too many cities.
The big pushback that I hear from people when I raise this concern is this time is different because the leases are much longer. It will take time for them to roll over. So there's some capital that's been locked in. A lot of the revaluation has been happening already in a very controlled way, and there are bidders that are coming in. How do you push back in the sense that this might not be necessarily a slow rolling depreciation that can be controlled into something that will force the downturn to accelerate and the Fed to cut rates?
I think at some point in time, the cost of carry is too great. And I think about Houston property in the early 80s when everyone talked about, oh, you know, oil price collapse. If you could just afford to carry this property, you could make a ton of money. And guess what? You couldn't. People were going to the sale of their homes and writing checks for somebody to take their house. So yeah, Houston property came back in a big way, but at some point you just get tired of carrying the property. We're seeing some of that already, where you see the property holders in some commercial mortgage-backed securitizations go, you know what? Here's the level of debt. Here's what I think the properties are worth. Here are the keys. Good luck to you.
So just to put a bow on this, there is this issue of whether you think that commercial property devaluation is what's going to trigger the Fed to be forced to come in and cut rates, a call that is out of consensus at a time when the Fed wants to push back against just that kind of idea.
Well, it's not just commercial property. I'm not sure how we wound up there, but there are a lot of other things going on, right? The regional banking system is still on life support. Many of the regional banks have their entire securities portfolios on repo to the Fed at par. And they're trading in the 90s, and they've got that cash at par sitting there to meet depositor outflows. Their loan portfolios put in place when SOFR was 1/8, not 5 1/8. Those are underwater too. Those are now with the Federal Home Loan Bank, so they have cash to meet depositor outflows. We'll know in 2 months from now, when we get bank earnings, what's happened with depositor outflows. My impression is there's still outflows at the regional banks. We don't know how the regional banks will operate until the Fed, the FDIC, the Federal Home Loan Bank are out of the picture, and we're a long way from that. Commercial properties, the second. The third is just the cost of funding corporate America. As I said, you had an infinite pool of free money available for several years. SOFR was 1/8%. Sure, you're a below investment grade borrower, slap a 4 or 5% credit cost on it. There's your 4 or 5% borrowing rate. Now you're in the double digits, and more of that will be rolling through. I think those are the concerns out there. I do look at the commodity index. I do think inflation is going to fall off a cliff here. And I think the Fed's got this wrong.
You've got 60 seconds left. Huge amount of T-bill issuance is going to come very shortly. Just quickly, with everything you've just said, is that a problem?
It shouldn't be. I'm hoping that it gives banks and money market funds somewhere else to put their money other than overnight reverse repo with the Fed. So maybe that will give us another avenue to invest.
Bob, this was a clinic. Need to do this more often. Come into the studio again. More guests coming around the table for a couple of blocks.
It's fun.
You know, it's fun. It's good to see you.
They come to Midtown, they talk about the crisis in commercial real estate because it's all emptied out. I mean, that's sort of the issue.
We're the only people around.
Exactly.
So you just want to drop by and have a cup of tea and chat. It's lonely out there.
John,
it's lonely out there in Midtown Manhattan.
John, my anecdote.
By the way, this is something we talked about yesterday with this liquidity crisis. There are a lot of people, especially on Twitter and whatever, they're like, oh my gosh, there's going to be this treasuries explosion of issuance. Oh my gosh, it's going to cause a liquidity crisis. And you haven't seen a market crash until you've seen a liquidity crisis. It's like, hello, have you looked at the reverse repo facility lately? It's actually something we broke down in detail yesterday. I thought it was phenomenal because it's just like, here's your idea and here's why it's wrong. But so it's nice to hear that reiterated. Hey, maybe you saw my video.
The offices are not. I'll say this, Bob, don't worry, we'll let you go. The banks, I love the banks who say that we've got to get back to work, get back to work. I saw a wonderful take on this, get back to work. But then it comes to banking and they cut branches because you don't need to do banking in person anymore. But you do need to do banking in person within the bank. Just, you can do it remotely.
I'm biased with this. Yes, but I'm biased with this.
If you're the client, the customer.
All right, so 4 minutes to the CPI release for Germany. A lot of people very curious about the Germany CPI release, specifically because technically they're in a recession. So 3.5 minutes.
No attention to that. They're looking for growth at all costs. We've been through recently another round of that, maybe because there was so much liquidity.
We went through super easy money for a couple of years, maybe 3 years there, and 2019, 20, and 21. And then the markets changed and the companies needed to change their strategies accordingly. And I think the stocks that have held up the best did. That's why Amazon's a bit of an outlier here, because they're still investing aggressively. They're not returning cash to shareholders. I'm not sure they need to, but they better show some material revenue growth acceleration. And if they don't, then they need to start becoming more mature. Then they need to start returning much more cash to shareholders.
Mark Mahaney. Mark, thank you. By the way, the book is called Nothing But Net. Great to see you.
Thank you, Becky.
I love how they start the music as a cue for, all right, cut this guest off. And yesterday I saw they have a way of extending that music if somebody's still talking and they're still yapping, but it's sort of like the signal, like, all right, shut up now. And that was because, what was it? I think it was Jimbo. He just wouldn't stop. And the music just kept looping. It was like that. Who's seen that meme of the guy with the bow and arrow or whatever, where, you got to concentrate on seeing the guy shoot. I think it's hilarious. Let's see here. Let me see if I have it handy. Loop. It's just a loop. No, of course can't find it right now. Bow and arrow loop meme. But anyway, it's just like dramatic. Oh, here it is. Oh, I found it. I love this. All right. While we wait for German inflation, if you haven't seen this yet, this is what it felt like. All right. Ready for this? This is the stuff you come here for. Okay. This is like the real quality content. You ready for this? Okay. Here we go. So they play this, and I'm not going to play all this music, but they play this Jason Bourne-esque music. And you're like, oh my gosh, he's going to do it. He's going to do it. And they literally just loop over and over and over again. And the trick is you have to play this for your friends and family, and you have to see how long it takes them to realize that he's never going to pull the trigger. It's actually hilarious. Like, you got to do this. You just show it to your friends and family and be like, I saw the sickest bow and arrow shooter ever. Check this out. And you hand it to them and you just walk away and just watch. Usually people watch for like 90 seconds and they're like, dude, what the hell, man? It is the best. Troll gif. Exactly. I don't know. It's great. But I think they can do that with the CNBC music, where they just basically just loop it like that. All right. So let's get this German inflation data. All right. Ready for that? That comes out in about 30 seconds. All right. So, all right. Here we go. Okay, German inflation month over month is expected to be 0.2%. The prior release was 0.4. Year over year, you're looking for 6.5 for the entire country. Oh, yes. Yes, it's good. Good news. Good news. CPI month over month for Germany comes in at negative 0.1% month over month. The expectation was 0.2. The year over year was expected to be 6.5. It comes in at 6.1. Then you get EU data. Expectation was 0.2. The actual result, a negative 0.2. Let's go. That's a nice solid drop in inflation. That's amazing. Then CPI, EU, harmonized year over year. The expectation was 6.7. What did you get? 6.3. That is a fantastic, fantastic indicator, especially since European inflation has always been substantially hotter than what we've seen in America. They hit higher peaks of 10 to 11%. They've been higher for a lot longer than us. And to see them now plummet under expectations is really good for our global economy. So I'm very, very happy to see that. You did also get what is this? You got New Zealand core logic housing prices coming in at negative 10.2%. But that happens in countries when you don't have the 30-year fixed rate mortgage. You actually get housing crises. But when you get the 30-year fixed rate mortgage, you don't. But anyway, this is actually really great news about this European inflation data. So I'm very happy about that. Let's see if we can get the actual report on that. So that's going to be the harmonized inflation report. They call it the HICP, which we could Google, and then we should be able to get our latest breakdown from today. Let's see if we can get it. And do we have, I'm surprised CNBC isn't even talking about it yet. All right, let's see here. We shall find where the inflation release is. Who knows? Maybe they will mention it, but let's listen in.
Off by 43. And Treasury yields, I think, have come down a little bit. Let's take a look at where things stand. You're going to see the 10-year yielding 3.645%. 2-year is below 4.5% at 4.411. If you look at the very short end yield, I saw that a little earlier, and it dropped even more, the 1 month, all the way down to 5.22%. You were talking about 5.8%, but it does look like this deal is going to get done, and the debt will get.
Wow, with each successful whipping of a member of Congress, yeah, it's like a basis point. Yeah. Basis point for every person that says, yeah, I'll go with it. Two stocks that we're watching closely this morning. First is American Airlines, a company increasing its second quarter earnings to the guidance to $1.45 to $1.65.
Anyway, yes, this is very fantastic. Yes, I hope German inflation comes in high, so the recession is even worse, and stock market and DAX goes to new highs. Well, I love that. Yeah, that is the German irony right now. Is they're in recession, and their stock market's at all-time highs.
Now down 27% after first quarter earnings per share missed expectations badly. 72 cents is what the company posted. Those savvy analysts that are right on top of the situation were at $2.57. Didn't see any issues. Revenue only slightly missed, and you know what that means. That means it was margins, and the company did say that's what it was. They had almost the expected amount of revenue, but didn't make any money on that revenue, or very little. Forecasting, this was the first quarter. Rest of the year, not much better, forecasting $6 and $6.50 a share. The previous guidance was $10.20 to $11.20 per share. If you bought this stock because of the yield, you're going to be also shocked because the company slashed its dividend 83% this morning.
Yeah, see, that doesn't surprise me. Is in this market, why would you pay out dividends, especially if you're a staple? The staples are just going to get whacked.
Really interesting stories, and taking a look at those short-term yields, those are coming down pretty precipitously.
They are, Becky. It seems like a little bit of fatigue in the overall equity indexes, weak economic numbers out of China. Oil trades very sloppily to the downside, and yes, yields coming in again too. So there's some hesitation about growth, but also pricing in that debt deal. Last day of the month, you've seen this little kind of grinding uptrend in the S&P 500 that has gotten us just barely above that 4,200 mark. See, it's developed here. As everybody keeps pointing out, a lot of the biggest stocks in the market are kind of, holding sway over the index. The average stock not performing that well, which raises the question, if those really hot performing stocks like the NVIDIAs, like Apple making a new high yesterday, if they do have to reset lower, have a new routine pullback, what would be a normal area to pull back to? Around 40, 50 or so is actually where we closed 2 months ago, March 31st. We've remained above that level for the entire period here, the entire quarter. And that would really still be a relatively normal setback.
Okay, here we go. I just got a little bit more insight on this inflation. So Germany joined its major Eurozone peers in reporting a steep slowdown. Oh, they misspelled that. We're so early. There's still typos in the article. reporting it should be steep slowdown in inflation, underscoring arguments by some ECB officials that interest rate increases were coming to an end. In my opinion, this actually could help with the U.S. pause. Consumer prices in the region's largest economy rose 6.3% from a year ago in May. Federal Statistics Office said Wednesday that's down from 7.6% in April and below the estimate of 6.7% in the survey that we just saw. The retreat came as, and this is, okay, the retreat came as fuel and heating oil costs tumbled, cheap nationwide public transportation ticket was introduced. Reports this week have already shown that inflation dropped more than anticipated in France and Spain, with prices in Spain rising just by 2.9%. The weakest in 2 years, while in Italy, the extent of the retreat there was smaller than expected. Still makes sense. More of an inflation drop in some of the developed countries. The developed countries are going to be more of your Germany and France versus the Portugal, Italy, Greece, and Spain. Of course, all considered developed countries, but relative to each other. Inflation data are key input to the ECB's next policy decision in just 2 weeks. That's also interesting. I wonder who's going to be first. Usually the Fed goes first. Let's see, though. Let's get the June 23 date and compare that. So they're going to, 1 day after the Fed. Darn. That's always how it is. You get them right afterwards. But that would be cool. Well, that will be interesting to see, but it'd be nice to see them go first for once. All right, let's listen to debt ceiling updates here just quickly for a moment. What's the latest here? Expecting vote today?
He just, I mean, it looked like he was facing like a tooth extraction without any anesthesia or Novocaine. He says it's going to get done. Why does it have to be this grinding process? And both sides, I guess, are guilty of it. Is there a Venn diagram middle of people that just agree this is not the end of the world if we cut spending a little and raise the debt ceiling?
The disagreement on the polls is obviously, as you would expect, diametrically opposite. On the far extreme on the right, it is not enough cuts in spending. On the left, too much cuts. So I think you are right. There is this big swath in the middle that's reflective of most of the country that finally rise to the occasion and pass the debt ceiling. It's just it's all about, the calculus of what your constituents are going to view this vote as and how it sort of plays out for you politically and then for the country from a policy.
I did see some absolutists on Twitter just say 2 words, man, term limits. It's the only thing that changes this, and you just said it. So they got their constituents are running for office every 2 years. The real ideologues on the right or on the left, do their constituents expect them to represent them that way? Is that why they do it? Or do they like making a name for themselves? Do they like, does Chip Roy like being on?
I mean, it's just a way of getting elected. Come on, we know this. But in the meantime, I just want to quickly mention the 5-year break even just fell again. It's almost at the lowest point where we were just about 2 weeks ago. The lowest point where we were 2 weeks ago is about 2.11. And right now we're sitting at about 2.12, 2.13. But dropping again, this is great. Inflation expectations falling. Inflation expectations are very anchored. That's going to help the Federal Reserve with their potential for a pause.
For office, you actually believe in something and you want to go and deliver that for your constituents.
Yeah, but the perfect versus the good.
But,
okay.
Right. In the end, you want to stay there in order to affect that goal that you've said you're about. And then it comes down to the incentives in the primary system. And what we've seen today is we've got a situation sort of writ large in our country where we're evenly divided. I mean, almost at parity, evenly divided. And then the unity within both parties is becoming even more so. So you've got a gulf widening between, you have a hardening of parties within. And because of that, and then you add on to this, the sort of partisan redistricting that goes on, the most important thing becomes the primary in most of the seats. And so that's when, Joe, this question.
It's all about the votes, man. It's all about the votes. Jolt's data, 20 minutes.
100 this month. If you're just tuning in, I'll go over those numbers again. It's up more than 8% this month. Equal weight S&P is down 3% month to date. That's 11 points of outperformance, Tom, in a single month.
I just, and by no means am I saying buy, hold, sell. Everybody knows I'm very comfortable.
Are they talking about me?
Triple leveraged all cash. I looked at Procter & Gamble. I looked at Walmart. These are stocks, John, trading at 20 multiples, huge multiples given their revenue growth, the stolid nature of what they've got. Take a troubled company. We all know 3M is troubled. They're down 62% from their 2018 high. They're down 47% since the beginning of last year. And let me tell you, there's no bid on the stock right now, pricing back to 2013. You can enjoy 3M this morning at under a 10 multiple.
Wow.
I mean, it's trading like Ford Motor Company, but is that how you describe a value trap? And again, I don't want to go into buy, hold, sell here. I'm just saying within security selection, what's really the value of a 12 multiple now or a 9 multiple? You got to be careful out there.
Or on certain stocks where multiples just don't seem to matter at all. Like Nvidia, which is just absolutely flying. That's the equity story on bond markets. We'll catch up with Jean Bavin of BlackRock in the next hour on Bloomberg TV.
I mean, in fairness, I think what everybody forgets, when they make these comments, is growth. Which companies are actually innovating? It's like Procter & Gamble talking about innovating diapers, or that was Kimberly Clark, or 3M. What are they going to do? Make another COVID mask? Whereas, I mean, look at some of the new chipsets NVIDIA just announced, creating their own GPUs to take full control of the server rack, not just the GPUs, but also the CPUs. It's incredible. It's a phenomenally impressive company with the incredible growth ahead of it. The question is how much growth, and that part we could debate. Is it going to be 25% year over year or 50% year over year? It's going to be a big difference for the server space. I did those numbers yesterday on NVIDIA. I was looking at if you grew at 50% for 6 years in just the server space after annualizing their next quarter of server spend or revenue expectations, and then you assumed about 50% would go to the bottom line after like a 70% margin, 15 to 20% growth or OPEX, you'd probably be somewhere around $60 per share just from servers in 6 years of earnings, which is insane. Because if you then take $60 and you multiply it by like a 30 PE, you'd have an $1,800 stock. Now, if they don't grow by 50% though for 6 years, then you're not an $1,800 stock anymore. Then, because of the nature of compound interest, if you don't grow, if now let's say you grow at just 25%, well, we can do the math really quick. That would be 1.25, 1.25. I could do this with exponents, but for the sake of doing this live, I would just do it really quick. That would put you at revenue that's less than half, which would put you at net that is less than half divided by the shares. Now you'd be at about 1/3 of the EPS, which that in 6 years then puts you at $20 earnings per share. $20 times 30 puts you at $600 a share. Okay, $600 a share would put you at, a couple $100 more than where we are now. But then you have to ask yourself, is that worth it over a 6-year time frame? Now all of a sudden other companies look a little bit more desirable. Usually deeper analysis, where we come up with those figures and some of that fundamental analysis we'll do in the course member live stream every single day. So if you want to join those, make sure you check that out. Link down below. The expiration of the next price increases tomorrow. Ratchet prices up again. So if you want to lock those in, make sure you lock them in. You get best price guarantee going forward. And that's already in about 36 or so hours that the prices go up. So check that out. Okay, so we are now 15 minutes away from the good old Jolts data, and that'll be one of those leading indicators for the Federal Reserve's hiking.
Stood back, didn't believe that the Republicans would pass a plan, but at that point, they didn't even know what they wanted. Tell me what's in this bill that they wanted. There was nothing that they got.
I think he wanted to keep as many of his legislative victories as he could.
Right, but they claimed they talked about student loans. They talked about increasing whatever spending they want. but they didn't have a plan. So I think it was a missed opportunity for them, and I think a victory for the Republicans and Kevin McCarthy for sure.
I mean, I see a blue check mark here. Someone just said they tweeted, you just got a shout out by at Joe Squawk, your big time, to Alexandria Ocasio-Cortez. And this is her tweet from a couple days ago. And it's got a blue check mark.
No.
How can you tell
Stop.
that from a parody account? Printing money.
Because it says if you click on it.
Well, did you read what it says?
Yeah, but if you
Printing
click on
money
it,
is
it's
the
not
only
her
way to
account.
cure inflation.
It's the parody account if you click on it.
Is it? Okay. All right. It is a parody account. So, okay. Thank God. I mean, no one would say that, would they? Printing money is the only way out of it.
It's awesome.
See, I was confused.
Okay. So I have to say, it's so hilarious. I don't know if that's like planned what they just did, but by far the funniest thing to troll the internet right now on Twitter is this. Because when you look at this on an iPhone, you actually get a cut off version of how this account looks. And it doesn't actually look like a parody account, which is really even more entertaining because some of the things that are said are so ridiculous that they're really entertaining and you kind of almost wish that those were real. So, and Elon Musk has responded to some of these parody account tweets, which is actually driving the real AOC completely mad. But this is what it looks like. I believe if I push this button, it'll work. Oh, yes. So look at this. When you scroll through these tweets, it just says Alexandria Ocasio-Cortez press ... And the whole like parody thing is cut off. And it looks like a blue check mark. And these tweets are going viral because people think it's actually AOC. And so this account for the last like 3 days has just been posting the biggest troll nonsense ever. You just saw it on CNBC. I mean, look at this. Printing money is the only way out of inflation. 6.2 million views, 39,000 likes almost. Let's see. Some of these are so ridiculous. I don't even want to say them. I won. The official AOC has blocked that account. Let's see here. What's another good one? Starting to believe Elon Musk is my soulmate. 700,000 views. What do you got over here? To make windmills more effective when the wind doesn't blow, we should have helicopters hover over each of them to keep them turning year round. I mean, some of it is just the stupidest stuff ever, but people think it's actually her, which is so great. I went to the beach this morning and the water was really low. I went back this evening and the water was really high. This is 100% proof global warming is real. Some of these comments are just, the things said here are just hilarious. I'm happy. AOC on her official account actually posted this right here, which is, FYI, there's a fake account on here impersonating me and going viral. The Twitter CEO has engaged it, boosting visibility. It's releasing false policy statements and gaining spread. I'm assessing with my team how to move forward. In the meantime, be careful of what you see. That is a copy and paste of what AOC's official account actually said. So it's entertaining. So AOC has a gray check mark, and you can actually see here on the website there is her writing that same statement. FYI, there's a fake account here impersonating me, and it's going viral. All that did was encourage more. Now, probably one of the best responses I saw to all of this was somebody saying, "Hey, you have a gray check mark. You know, politicians have gray check marks. Maybe parody accounts should have clown emojis instead of check marks." Best comment by far. Somebody replies and says, "You got that backwards. The politician should have clown emojis." And the parody account should have a gray check mark. It's great. So anyway, I don't know. I thought it was just, I mean, at least there's some humor left on the internet. All right. 10 minutes away from Jolt's data.
As a client, JP Morgan says that those statements are false. A spokesperson for the bank said that Diamond maintains he has no recollection of ever discussing or reviewing Epstein's accounts and that he doesn't believe such conversations with Staley ever happened. Diamond was deposed last week as part of 2 lawsuits against the bank, accusing it of facilitating Epstein's alleged sex trafficking. JP Morgan, for its part, has tried to push back and say, no, this was just Staley. This is where things have gotten pretty complicated. JP Morgan spokeswoman, though, says there's no evidence that any such communications ever occurred, nothing in the voluminous number of documents reviewed, and nothing in the nearly dozen depositions taken, including that of their CEO.
And when we come back, is Las Vegas the next Hollywood? Contessa Brewer is live in the Silver State and will join us next with that story. Contessa, what do you have coming up for us?
Well, Joe, you know, silver used to fuel Nevada's economy and then gambling, of course. But the state is on a mission to diversify its economy beyond gaming and tourism. And there is a big push to coax the movie business and all the jobs it brings here. Coming up, I'll explain why some think that's a bad bet. Ahead on Squawk Box.
Yeah, whatever.
Democrats who are concerned about the alternative.
I actually disagree with the analysis. I think Kevin McCarthy will remain speaker with Republican votes. I actually don't even think you'll see a motion to vacate. We had a robust family conversation last night into the late hours of the evening talking about this legislation. And while it's true, there are some Republicans that would like to see a better bill. They think that they could get a perfect bill. At the end of the day, I think everybody in the room recognizes that this bill is a step in the right direction, and they're appreciative of the Republican negotiating team that moved the ball forward. You got to remember, we started with the president saying that he was going to refuse to negotiate. He put his head in the sand. He went to Delaware, went off to Japan rather than negotiating. And at the end of the day, we came back with $1.5 trillion in savings.
You sound like Paul Ryan on an off day. Come on, Congressman, come on. What I'm hearing in the zeitgeist right now from Anne Marie Horton is the Democrats are taking a victory lap because they pretty much got what they wanted. Moderate Republicans like you are saying, okay, let's get this done and move on. And you got a bunch of people trying to block this and shut down the government. I got to go back to the fact you lived Paul Ryan's decline as Speaker of the House. I want to go from Boehner to Ryan to McCarthy. What does the Speaker have to do now not to be Paul Ryan, not to be John Boehner?
Oh, I think actually the Republicans are quite unified in the House right now. And I think that shows when we passed the Limit, Save, Grow Act. Many people across the United States underestimated the ability of Republicans to come together and unify and pass a bill. In fact, President Biden didn't think we could do it either. That was part of his negotiating tactics. And at the end of the day, we came together. I think the Republicans...
Is that supposed to be like a bragging right? Like we came together and passed a bill, like we did our job?
But, you know, the Speaker, okay, I'll go with that. But the answer is, John, the speakership here is under real threat, and it comes up suddenly. Did it come up suddenly, Congressman, for Paul Ryan? Was everything fine, and then boom, you're his aide in office, and all of a sudden, boom, he's under threat by these Republicans?
I was working in the private sector for quite some time, so I wasn't on Capitol Hill for about 20 years before I ran for office. But I think what you see is at the end of the day that these things can rise on occasion. But if you talk to Republican members, we're unified in the House of Representatives. Okay. I think everyone recognizes that this is a good bill. There's just some conservative and Republican members that would like to have a better bill. That's not the bill that's on the table.
Congressman, I'm just a spectator and watching this play out for a long time, both within the United States and abroad as well. And every single time we get into this debacle, we just raise the debt ceiling again and again and again and again. Whether that's a Republican president or a Democratic president, it's the same outcome. We raise the debt ceiling. Brian, you heard JP Morgan's Jamie Dimon come in from the break there saying, I wish one day they'd get rid of the whole debt ceiling thing. Why do we still have it? And isn't it somewhat embarrassing for the president, whether Republican or Democrat, to go abroad to places like Japan, for the G7, to try and lead the global effort on a whole bunch of issues, to then be looking back and have this EM-type debacle playing out at home?
In a period of time of divided government, there's actually few opportunities to negotiate the spending reforms that are needed, in particular a period of time when executive authority has grown so dramatically. In this bill, we actually address the fact that the president tried to dramatically alter student loan payments. That never went through Congress in the first place. Unfortunately, based on executive overreach, What we have is so few opportunities to get spending under control, where the executives, both parties, are absolutely right, continue to spend money through executive action. And this negotiation allows us to actually bring the president to the table and have a conversation about how we're going to get spending under control. And I think, again, at the end of the day, this is overall a good bill moving us in the right direction.
Yeah, the one bill aside, Congressman, don't you see where this is going, though, that ultimately, and we're out of time, so if you want to continue this conversation, by all means, come back another time. It just feels like we're in the process now of deliberately manufacturing crises to do exactly what you just explained. And at some point, that's going to erode the confidence in this country and potentially the US debt market too. So we've got to leave it there. Congressman, if you want to continue, happy to do that another time. Congressman Bryan, stay on there.
4 minutes to Jolt's data.
Big issues, and they're not getting away anytime soon. Let's be clear about that, no matter who wins
I
the next
agree.
election.
I'm trying to get a measure of Speaker McCarthy's risk as we move forward here. He had a good day yesterday.
Hornback and Morgan Stanley up in the next hour. Joe Carey Hall of Bank of America, Jean Balvin of BlackRock, all of that coming up in about 30 minutes.
All right. 3 minutes for Jolts.
Later today and see if I can get a feel for how this thing is going to go, Becky.
Yeah, really interesting story. Contessa, yesterday there was a story on the front page of the Wall Street Journal that talked about how the casinos are seeing so many people coming through that they're doing all kinds of things to weed out the lowest level players. Things like raising the stakes that you have to put down at the table, having it be much more complicated to win, lower payouts going out. Again, that seems like good ideas potentially during boom times, but if there is a downturn and if consumers stop spending, all of a sudden they may wish they had some of those players back.
You know, it's really interesting because some of those tweaking the odds a little bit, like I play roulette, and I noticed a few years ago, even before the pandemic started, that you'd go in and you might see a table with triple zeros instead of just two zeros.
One
so that
zero,
increases the odds for the house. Right, exactly. What we saw in the pandemic was that social distancing required more space between players, fewer tables. And so it was really important for the casinos that the people that were sitting at those tables were higher value players. So what you saw is the minimums going way, way up. And that there too, the blackjack odds might change a little bit, where instead of paying out 3-2, it might be paying out 6-5. Again, that helps the house win, right? Tom Reed got a lot of attention for saying on the earnings call that, yeah, that tends to weed out your lowest demographic player. And they're coming and they're spending. But yesterday, Becky, I talked to Derek Stevens, who owns 4 casinos here, and he said, look, what we're seeing is that people are coming for the entertainment, and it just doesn't matter what the odds are in the casino. That little bit doesn't seem to faze them.
Yeah, that was a great piece in the Wall Street Journal yesterday. They essentially said, look, we have so much demand for casinos that we could just pay lower odds and raise the minimums, because even if we do, people are still coming. Really thought that was interesting.
She would not have a blue check mark.
Was it her?
No, that's
she
a
had
parody.
the gray one on her
She has a
bill?
gray one on the real one, Kevin McCarthy. Yeah, so it's
Latin
gray.
rules to remember.
No, that's an easy one, that's important, I think. A gold check is for business too. There's a gold, there's a blue, and there's a gray. Coming up, Lazard's incoming CEO, Peter Orszag.
He's still confused about the AOC thing.
Washington, stay tuned. You're watching Squawk Box on CNBC.
Oh my gosh, that's just entertaining. He's so offended that he got caught live on air getting basically baited by and trolled. I mean, he got trolled is what it is. That's quite funny. That just makes it even more entertaining. I feel bad. No, I don't actually. It's funny. Yeah. No. All right. So, with that said, we have Jolt's data to cover. Let's get it going. Jolt's data. Here we go. Jolt's expectations, 9.4 million job openings. Prior release, 9.59. The current release, oh crap, it doesn't actually come out until 7. I'm sorry. Dang it. I totally hyped you up for nothing. That's all right. I can't believe I misread that. My bad. dang, I totally thought it was going to be this minute. It's going to be supposed to be right now. No, it comes out at 7 a.m. Pacific time, 10 a.m. Eastern. Who waits that long to come out with the JOLTS data? That's lame. Sorry. All right, we'll have to look at something else instead. So I don't know. How about we go look at the sticks? We could do that. Could look at Canadian GDP. Okay, fine. We look at that. But that's not as fun, eh? So mortgage applications down 3.7%. That's boring. All right, fine. Canada GDP. That's true. That just came out. Oh, wow. So the survey was that Canada's GDP would come in at negative 0.1%. It actually came in at 0% month over month. And GDP year over year came in an actual of 1.7 versus the survey of 1.8, barely avoiding a recession there. So, okay, fine then. Another 90 minutes it is on JOLT. Then we are going to take a peek at how the pre-market is moving. Let's see here. So in the pre-market, we've got the NASDAQ down about 0.5%. You've got Enphase down about 1%. Tesla down about 1%. Intel down about 1%. You do have some reports coming out today. You've got Salesforce coming out today. Salesforce is up about 0.3 right now here in the pre-market. You've got C3 AI reporting. I don't know. I mean, I think all it's going to take from C3 AI is some bullish guidance. I don't know if it would be realistic. I don't know how many companies are going to flock to C3 AI for more revenue, but who knows? Maybe we'll be blown away and we'll get some off the chart numbers. But CrowdStrike, Salesforce, C3 AI, Chewy, Okta, Nordstrom, they all report after the bell today. So we should see some entertainment. Nvidia down 1.72 now. Dave & Buster's down a couple percent. Just like Bitcoin, also down about 2%. S&P down about 0.4. One thing we're also seeing fall now are treasury yields. Treasury yields finally slowing down. And that comes as mortgage rates just hit an 8-month high. Mortgage rates for lower credit scores now as high as 7.5% to 8%. 740 prime credit scores still sitting around 6.9 to 7.5, depending on where you look. But the 10-year falling right now to about 3.67. Okie dokie then. So let's see what else there is to learn. Let's jump on over here and find out.
Economy. How much are you hearing that from economists?
Oh, you're hearing that a lot. It's probably the biggest thing in this debt ceiling package that would affect the economy because the overall numbers are pretty small, but we could see a compressed period of declining domestic spending if people who are spending that average $369 a month payment on something else right now have to start sending it back to the government lenders. But it's also been pointed out that when they ended the supplemental food stamp program and when they ended the supplemental child care tax credit, we thought that would happen and the effects were much smaller. So it is certainly possible that it doesn't have a major impact on the economy right now. And of course, it'll be a little hard to tease out in terms of other things that have been going on, the Fed raising rates, et cetera. But it will be something to watch.
Michael McKee, thank you so much. The JOLT survey out, I believe, in the 10 o'clock hour. Bluerina Urici joins us right now, U.S. economist T. Rowe Price. Here on the shifting tides of the American economy. Just as a basic idea, do you have any handle on second quarter GDP yet? I mean, everybody's waiting on recession, but what's the T. Rowe Price call on where we are in growth right now?
So right now it feels like we're going to get another quarter of positive growth, at least the components that I take more signal from, which is consumer spending and personal consumption expenditure component. We have had a lot of volatility in the inventory data and net trade, but overall, when you look at consumer spending in the US economy, that has been holding up. And actually, a lot of people expected this shift in spending from goods to services, but we actually are continuing to see in the economy that both components remain strong and the U.S. consumer goes out to spend.
One of our themes is a return to American exceptionalism. Country by country, they seem to be slowing down, widely anticipated by IMF and frankly by you. At T. Rowe Price, is America the place to be because of economic growth?
Well, I think we saw that last year, and I think that theme continues, that the Fed was able to increase interest rates faster and sooner here than other central banks because of the resilience of the economy. The U.S. consumer has been strong. I do think, however, that the direction of travel for the second half of the year is one where a ton of headwinds are gathering momentum. So the U.S. economy is going to slow as well, and we're already seeing signs that the labor market is starting to cool down. All those things, I think, are going to play out such that the U.S. will not be as strong in the second half of the year as it was in the first half.
This is like the super mainstream argument right now is that the second half slowdown, maybe it'll happen. I mean, everybody's willing it, so maybe it'll happen. We've got here household debt service payments as a percentage of disposable personal income. I love this chart. I like to see this because I like to compare where we stand now, because everybody, especially if you look on Twitter, everybody keeps talking about how consumers are spending more money and it's all on debt. Well, if the debt bubble is so freaking terrible for the individual consumers, why is it that we're basically at or slightly below the levels of household debt service payments as a percentage of disposable personal income? In other words, the money that you have left over, what percent of the money that you have left over is going to debt payments? And that number is about, on average, 9.7%, which is consistent, or maybe even a few basis points, 10 basis points below what we saw in 2017, 18, 19, 16, 15, 13, whatever. It's actually a whole percentage point below what you saw in 2013. Not quite. It just ends up going to be about a whole percentage point lower than like 2010 or 11, but maybe more like 30 basis points lower than 2011, 12. But anyway, point is, this number's not skyrocketing. And sure, maybe it will, but let's zoom in on this a little bit. This is a quarterly report, so we only have the Q4 data. Who knows? Maybe Q1s will skyrocket when the new data comes out. But I mean, if you look, the difference between Q3 and Q4 was flat, barely increased. You can see that rate of growth really decelerating. It's almost like you're hitting this resistance line, getting back to a trend, which is becoming that resistance line. And you're not actually seeing an explosion here. Of course, again, it's daily that I see people talk about, oh, but Kevin, household debt is way up. Everything is so much more expensive. It just seems like a lot of doom and gloomy when the reality is, when we compare debt, for example, of the United States to the level of our GDP, you could look at household debt and then compare it to the level of what our GDP is essentially. And when we compare that, well, here's what that chart looks like. You can see that the level of household debt was anywhere between a 94 to a low of about 75x. And we're sitting about 76 right now, which is consistent with about the lows pre-COVID. So once again, when we actually make some of these numbers relative to our capacity to repay the debt, this individual debt bubble that everybody keeps referring to, I personally don't see it. I don't know. I suppose if you just looked at like nominal debt, I mean, if we just looked at like personal debt or like total credit outstanding, right? There, if we solely just looked at consumer credit, yeah, straight up, right? But this has nothing to do with your ability to repay it. Of course, it's a straight up line. It's basically always going to be a straight up line because, well, inflation, right? And then over time, of course, the number goes up. Now, we could look at this as a percent change from a year ago. There we go. So here we could see, oh, but percentage-wise, it looks like, hey, wait a second here. We're comparing to this whole of the 20s and or 2020, early 2021, and then it looked like, oh, well, we basically 3x our debt increase from the prior year, and now it's just rolling over. Sure, it's true. the nominal level of debt has exploded after the pandemic. But again, if our capacity to repay has made it such that we really haven't changed anything, whether it's household debt to GDP, or we look at household debt service payments as a percentage of personal disposable income, is it necessarily abnormal? Or was that just people playing catch up from the debt spend that really didn't occur during COVID? The odds are it's probably that. So I find that very challenging argument, but it's one that does continue to come up. Yeah, oh well, let's listen in over here.
All of us IMF cred. And then having Leland Miller come up is just exceptionally fortunate today.
To understand the on-the-ground reality behind
Yeah.
the pretty disappointing PMIs that came out. How much is this just manufacturing not keeping up and services continuing to chug along? How much? And this is really the key question. You kept bringing it up, and I think it's a good one. Is there really an inability or a complete reluctance by the Chinese government to offer up some stimulus in some capacity?
I'm in the camp here. They don't have a choice because of the mandate of
regarding the Canadian inflation numbers, those were month over month, Mr. Max. And regarding this rollover, yeah, certainly when you have a recession, you tend to see debt rotate down because you see defaults on debt. Certainly what you saw here with the Great Recession, right? Big rollover here. Even in the 87 sort of market crash era, you saw this rollover of household debt. So not uncommon to see some kind of start in a recession of this sort of debt payoff. But what's remarkable is just how low we are now. It's like, how much lower do you go? Do you go back to these levels around 8%? I mean, maybe if you have a recession, that probably would happen. But to just solely say, oh, that's it, our economy is screwed because of the levels of household debt payments relative to everything else. No, I don't know. It's a tough argument. It's, I guess I should say, an unconvincing argument.
Get that story next.
Or would it be more punny to say an uninteresting argument because you know, it's debt? No, probably not. All right, CNBC just wants to go back to commercial. So I guess we're stuck over here for a second.
And bad times, remaining committed to doing business in the Communist Party-ruled nation. CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Over time, yeah, there'll be less trade. You know, it'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
Diamond's remarks come as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met with China's Minister for Industry and Information Technology. Now, Musk is expected to tour Tesla's Shanghai factory later today. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. North Korea has also confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Somebody here, right? My cousin went into debt for Taylor Swift. That's actually pretty common. You'd be surprised how many people go into debt to go to the Taylor Swift concerts because they just want the best tickets. I mean, people, it's wild, but people who just have no business affording $2,000 or $3,000 Taylor Swift tickets will somehow spend $2,000 or $3,000 on a Taylor Swift ticket. It's remarkable. And, you know, Taylor Swift is all about like, oh, I want tickets to be affordable for my fans. You know, oh, it's, you know, we don't want to raise prices. It's a complete hack because all that happens is you have scalpers who end up buying the tickets cheap for, you know, $100 or whatever. And then they resell them for like $1,000 or $2,000 or $3,000. And it's crazy. If, you know, they wanted to actually have fair pricing, what they would do is they would let the market determine the pricing. and those profits would go to Taylor Swift or the stadium. And then you probably have net lower prices for everyone because you wouldn't have a middleman involved. You'd be cutting out the middleman, the scalper, which as much as they try to do every single year, there's still a scalper every single year. So you're artificially inflating the cost of these tickets, leading consumers to go into even more debt because there's this refusal to actually let the market dictate pricing for these tickets. So instead, they'll rather put you in a 10-hour queue so you could pretend like, if you show up early enough, you're entitled to your $100 ticket or whatever. But by the time you actually get in the queue, all the $100 tickets are already gone except the nosebleeds. And then you're like, what the hell? Now I have to buy from a scalper anyway. So it's just a complete failure to respect the free market. But hey, if Taylor Swift could just keep saying, don't worry, I'm taking care of the fans by making sure that they get low prices and we don't raise our ticket prices from $100 or whatever her base fee is, even though her fans end up getting screwed, at least it lets her say her prices are low. But it's a total farce. It's literally like a politician. It's like a politician going, we're going to make something cheaper for you. And then guess what? You end up actually paying more for it. It's the complete opposite. It's stupid. Price caps don't work. It should be like Econ 101. Oh, wait, it actually is Econ 101. You parked next to Taylor Swift's jet. That was cool. Yeah, that's true. That was pretty cool. That was an honor. All right. So, let's talk about Jamie Dimon. And there's actually been a lot of talk about China lately, mostly because China's in the dumps. A lot of people talking about, well, China, we're not decoupling from China. We're just, slightly de-risking. Jamie Dimon, Elon Musk, and others sort of echoing this. All right, what's this? Real incomes will expand. Let's listen to it.
Foundation for Mr. Dudd of Renaissance Capital.
Yeah, return of the bond boom, and this is really the key question. I mean, we talked about Jean Bovin going over of BlackRock with John.
Max says, "Don't let the Swifties come for you." If the Swifties would open an economics book, they would agree with me, and they would actually encourage Taylor Swift to enable free market pricing for her tickets. So they stop getting ripped off by scalpers and going into debt to buy tickets to the benefit of the scalpers. It's not to the benefit of the customer. It's not to the benefit of Taylor Swift. It's to the benefit of the scalper. And then you know what people say, though? Then people are like, but Kevin, if Taylor raised her prices, there would just be scalpers anyway. And then they would just put more of a profit on top of that. And it makes me just want to grab them and shake them and go, do you not understand economics? There is a limit to the price that people will pay. There is a limit. That's how economics works. It's called the elasticity of demand. People will not pay an infinite price for those tickets. There is a limit. And somewhere there's an equilibrium where supply meets demand. And if you do not understand that, then honestly, you have no business talking about economics and pricing anyway.
Has been better than what the government's been putting out. So we're not seeing the worrying falls that have perpetuated this gloom. Stock market falling and economic data being weaker than expected has created a sense of gloom in markets, and we're just not there.
Dr. Lee talks about a dearth of innovation, which comes from a more strident autocracy in Beijing. No question about that. Given the changes that you see off the party Congress, is this a Chinese leadership that could still use traditional monetary and fiscal stimulus to goose the economy?
Well, the economic model still relies on that in part. They're just a lot more restrained and, constrained from being able to do it in the way they did before. So, yeah, I think that there are elements that, as things get worse, they're going to be under more pressure to stimulate. And look, I think the mistake right now is people think they're not stimulating. We've seen a lot of policy support already this year. We're seeing rates sliding. We're seeing loan rejections falling, which means the government has been more permissive in credit provision. So it's not nothing. It's just that they haven't resorted to the big infrastructure build out. They haven't been building in order to stimulate growth. I think they want to stay away from that, but they are being supportive on the monetary side. So policy support is there. It's just not what it was in the old days.
Leland, you said that people have been too gloomy on China. Where specifically are people underestimating how much strength there really is?
I think there's two places. The first is, everyone's shaking over this latest manufacturing PMI. When we look at our manufacturing data, we're not seeing gloom in terms of orders. Domestic orders are okay. Foreign orders are okay. They're weaker to the U.S. and Europe, but they're stronger to Asia.
All right. Darby writes, not for T Swift, people will pay. It's not how it works. Let's make this very, very simple. If the Taylor Swift tickets were $1 million, how many people would pay? Very few, because people don't have $1 million. So, if the Taylor Swift tickets were $0, how many people would go? Probably 1 billion people. So you'd go from maybe 100 people willing to pay $1 million a ticket to 1 billion people willing to pay 0. And guess how economics works? As you raise the price, oh my God, the number of people willing to pay goes down. So if you're at $100 and you have 20,000 seats, but you're at $100 and 100,000 people want to go, you have 20,000 people who go and 80,000 unhappy people who couldn't go even though they were potentially willing to pay more. This is where you enter the scalpers to make extra profit and rip off Taylor Swift fans to the benefit of, again, not Taylor Swift and not the customer. Now, if you raise the price to, say, $420, and now all of a sudden 20,000 people wanted to go and 20,000 people were willing to pay $420, oh my God. There's no market for a scalper anymore, because as soon as you raise the price above and you go to $500, well, now all of a sudden maybe there's only demand for 17,000 tickets, but you have 20,000 seats. So now you don't sell them all. And when you don't sell them all, what happens? The price compresses right back down to $420. Holy crap. It's almost like the free market functions. Oh, no, but people will pay anything for Taylor Swift. No, there is a limit. I think the problem is trying to explain economics to some people. Like, again, Darby, I wanted to grab you and shake you. Just because some people will pay $1,000 is the same as saying some people will pay $1 million for the ticket. Some people will pay $1 million for the ticket. That is true. Just like 1 billion people will pay 0 for the ticket. But that does not mean all 20,000 people will pay $1,000 for the ticket. The median, my guess, and I'm making it up, is probably somewhere around $420. That's my guess. But Taylor's selling it for $100. So by having the price too low, she creates an artificial lack of supply. Well, really, what she does is she amplifies demand substantially. The supply is what it is because you have as many seats. So really, you're massively amplifying demand. And so what do? You create a shortage. I don't know. Maybe some people just need like a picture drawn or something like that. It's like because it's I don't know. It's just not that hard. But then again, I guess if somebody hasn't taken economics, they wouldn't know. But so here, look, it's simple. If you draw a curve, okay, supply, demand, price, quantity, okay? This is a supply-demand curve. Welcome to Econ 101, okay? If the price of equilibrium, P and Q, if the price of equilibrium is $420, and this is 20,000 tickets right here, and we've got, let's see here, our supply curve is up here, and our demand curve is here. That is, oh, sorry, I screwed that up. hold on. Demand. No, I don't know that is right. Supply. Gosh, it's been years since I've done this. Supply, demand. That's correct. Okay, good. So now all of a sudden, to fact check this as demand, quantity demanded goes up as price goes down. That's correct. Okay, good. So now Taylor Swift comes in and says, I'm going to sell the tickets for $100 per ticket. Okay, well, you move over on the curve, and what do you see? Oh, well, at $100 per ticket, holy Jesus, there are 50,000 tickets demanded. Okay, but there are only 20,000. I cannot make the stadium larger. Now, you could offer more dates, right? And that would be a way of increasing supply, but for that night, you can't offer more dates. So what's all of this orange right here? All of that orange right here is your scalpers opportunity. It's sad people, and it's a shortage. That's what the orange is. So anyway, the point is, from an economic point of view, this guy or girl, I don't know who it is. I'm not going to identify them. They have no idea how economics works. Unfortunately, there's a chance a lot of Swifties have no idea how economics works. And it probably starts with the fact that some people are actually willing to just go into thousands of dollars of credit card debt for a concert. And don't get me wrong, I've been to all the Taylor Swift concerts. I love the Taylor Swift. But some things don't make sense. It's okay. This argument that Taylor Swift should not raise prices is stupid. But whatever. Okay. So let's move on to this.
Hard landing, driven by the cumulative impacts of the 500 basis points we've already had, in addition to the slow burn of the credit tightening we'll continue to have.
Okay.
So it's a matter of timing. And so this idea of a soft landing.
We kind of muddle along until we don't really have a soft landing. We muddle along until we have the hard landing.
If you think of a calendar year, then a soft landing for this year, but we don't think that's a steady state.
So it's coming.
And then
The hard landing is coming
odds.
eventually.
And here we're talking about soft landing, would call this growth of middling along, 1.5% GDP, which seems to be what we've had in the first half, could be what we have in the second half. And then we get a small hard landing later.
So
the next
shallow hard landing? This sounds horrible. It sounds even worse.
But people say that you don't get a real bottom in stocks until you actually hit the actual recession. So there's no reason to we won't see the ultimate lows till next year then?
No, if we think about the October lows that we had back then, we're 17% above them, and it seems very unlikely that we'll retest those lows. I think we're speaking more about market leadership from here on out.
So even with a hard landing, we would not, we wouldn't go back to those October lows.
We find it unlikely because we have adjusted earnings expectations lower, right? That was one of the main things we've talked about ad nauseum for the last year. And those have reflected a slower economy, margin pressure. We're now only looking for earnings growth of 1%. We've also had substantial multiple contraction. So we're not arguing for being too bearish if you just think about a 60-40. But we're also arguing for not getting too bullish on the other extreme. So being pretty neutral stocks and bonds. But more the focus is thinking about the market of stocks, not the stock market.
Right.
So thinking about the quality factor and the defensive sectors.
The S&P was kind of flat for 2023 in terms of not the averages, but the earnings of the S&P, basically flat. We saw, as you said,
1% flat.
Right. Sure. Everybody's banking on 2024 being another 10% year, 15% earnings growth. Yeah. That's not going to happen if we have a hard landing. So that's a fake. Those hopes will be dashed in your view.
So we're very close to starting to focus much more on 2024, as you know, it's always about the next thing. And those do still look a bit elevated at 11%. So it would be natural to start that process of bringing that lower. Not just about hard landing, soft landing, but about margin pressure.
Okay.
But of course, you can have some multiple expansion.
Right.
Before that.
Okay, I swear the Federal Reserve, they listen to us. This is scary. That's crazy. Hold on a sec. We got to talk about this. All right. How are we going to do this? How are we going to do this? We're going to do this. We're going to play some music. You ready for this? Are you ready for it? Oh, man. Getting too Swifty here. You're going to piss off some Taylor Swift fans. I don't to take your prices. I'd rather pay the scalper. Oh, the comments are going to be great. Anyway. So, well, the Federal Reserve is back at it again, and now it's almost as if they listened to my video yesterday, which is really scary because maybe I just shouldn't have said it. But yesterday, we got numbers that real estate was actually doing quite well. At the beginning of the year, real estate prices started ticking up again. We've known this. We've been tracking it every single week almost. We've been talking about how, geez, real estate prices fell between May of last year, bottomed out in December, started recovering in just the last 5 months here. Now home prices year over year are down maybe 3% on average nationwide. If you look at Miami, Tampa, they are positive. And you look at Austin and Boise, they're still quite negative, over 10%. But one of the concerns we brought up yesterday was this idea that, remember how there were 3 parts to the inflation fight? And this is a problem. This is something we're going to have to pay attention to. And you know me, I will always flip-flop if I need to. But one of the things that's actually concerning is that you have 3 aspects of the inflation fight. You know this already. This should be redundant to you. Goods, disinflation. What's the next one? Should roll off the tongue, okay? It should roll off the tongue. Housing, okay? And then what's the next one? So if this one is hint, hint, housing services, then what about this one? How about everything except housing services? So services X housing is what we call it. Okay, cool. So these 3 things are what we expect to help bring inflation down. By the way, the good news is I'm not counted in CPI. So when I say something like, hey, check out the programs of Building Your Wealth link down below before the price increase on June 1st, which is in like 36 hours at the time of this recording, we're not counted in CPI, so we're good. If we were counted in CPI, because you're locking in the best price guaranteed, you can email us if that's ever not true and give you a price adjustment. But because the price goes up over time, if we were counted in CPI, it'd be short in the SPY. But anyway, so goods, we know that disinflation is happening. Housing services, we've been told that we expect this disinflation to come because leading indicators of rents have fallen. Nationwide rents have gone from about $1,970 down to about $1,900, which is good. You've actually seen some softening in housing services, which is great. That takes a year, though, to really show up in the year-over-year data. That's how roll-off works. That's how base effects work. Now, Jerome Powell said this is in disinflation. We expect this to be in disinflation. But Jerome Powell has also said we have not yet seen services X housing disinflate. And part of that is because it takes wages to soften to see this come down. Now, ordinarily, you would have to see the JOLTS data come down. So ordinarily, you would see job openings data come down, and you would see the unemployment rate go up. So far, we haven't seen the unemployment rate go up. You've just seen sort of some of the job openings fade away, which is good. It's a sign that maybe some of that sticky inflation in services will slowly go away. The problem is, and we talked about this yesterday, the problem is, what if all of a sudden rent prices and home prices actually start trending up again? Well, what you do then is you actually suggest, we could, instead of seeing the expected disinflation in housing services, we could actually see reinflation in this segment. Now, I don't have that expanded to real estate inflation, which is kind of exactly correct, but let's not have it auto expand. There we go. So you can see reinflation here, which would be bad. And we talked about that risk yesterday by looking at the FHFA month-over-month data and the S&P, or rather the Case-Shiller CoreLogic 20 city home prices, which all came in a little hotter than expected. And so there's this red flag here that we touched on yesterday. And just now, Federal Reserve Governor Michelle Bowman showed up this year, said the following, quote, while we expect lower rents will eventually be reflected in inflation data as new leases make their way into calculations because of the lag that it takes to get leases to show up in CPI data. With home prices leveling out recently, here. The residential real estate market appears to be rebounding with home prices leveling out recently, which has implications for our fight to lower inflation. She just said this today, just a few minutes ago in Boston. She says essentially that, hey, wait a minute. What if this could cause a reanimation of inflation? And this reiterates Loretta Mester's comments as the Financial Times reported this morning, but not just the Financial Times. Other people have already commented on quite a bit. Loretta Mester just recently here said the headlines suggesting rate cuts aren't that, quote, compelling. In fact, she sees, quote, no compelling reason to stop hiking interest rates. In fact, she says, quote, I would see more of a compelling case for bringing rates up and then holding for a while until you get less certain about where the economy is going. A lot of this could be driven by the fact that the banking crisis is somewhat turning out to be a little bit of a nothing burger. Originally, the Federal Reserve was considering pausing more because of, or considering a pause for June as more likely, because of the banking crisis. And it was seen that the banking crisis was really a catalyst that contributed maybe somewhere around 50 basis points of rate hikes. Well, if there's no banking crisis, that means we potentially need to get to about 5.5% instead of the 5 to 5.25 where we sit now. That would be two more 25 BP hikes. The futures market right now is pricing in about a 62% chance of a 25 BP hike with a 38.2% chance of a pause. As far as July, it looks like we're most likely with a 54.2% chance to pause. And then September, you're sitting at 42% to pause at that 5.25 and potentially start pricing in your first cut from 5.25 to 5. So markets are definitely leaning towards favoring the idea of one more rate hike, which stands in contrast with what Jerome Powell just told us. Jerome Powell told us, hey, we're at a level that is sufficiently restrictive. And that's a way of him saying we've reached the level that we need to get to. He's also convinced other hawks like Neil Kashkari to pause, though Kashkari not voting, Kashkari is Bullard's not voting right now. He's the other bull. Bullard wants us to get to 5.5. Loretta Mester also in the conversation, the Financial Times mentioned, suggested that Mester still says she could be swayed by incoming employment data due on Friday, as well as the next inflation report. She says, quote, I just think we may have to go further. At this point, I don't really necessarily see a compelling reason why we wouldn't want to take another small step to counter some of that really embedded, stubborn inflationary pressure. We're getting to the real hard part here of how we assess trade-offs. Different policymakers will have different views about how they are assessing things. So you're starting to get that dissension at the Fed, the lack of unanimousness. Now, remember, we have jobs data coming out on Friday. That's in 2 days from today. That's on June 2nd. We're going to have this jobs data. The jobs data going to be a big deal because we are going to look for, hey, is the economy trending towards recession or is the economy still booming? Whether or not that's going to be good news or bad news is probably all going to depend on the average increase in average hourly earnings for employees. So we expect non-farm payroll to come in at 195,000 jobs. Private payroll is 164. We expect the unemployment rate to actually tick up from 3.4 to 3.5%. Average hourly earnings to move up 0.3% month over month and year over year 4.4%. Obviously, if we get a miss on that average hourly earnings, could be a red flag. And then, of course, on the 14th, we're going to be getting the inflation report. Sorry, that's on the 13th. We'll get the inflation report. On the 14th, we'll have the Fed. Inflation report on the 13th is currently projected to come in at 0.3 month over month. And for a core month over month, we're looking at 0.4%. If we can come in soft on all of the inflationary data, we will probably get a pause. So this is the cycle where there is actually a real possibility of a pause. Previous cycles, it's always been clickbait that there would be a pause or a 50, or higher than expected. It was always very well telegraphed what the Fed would do. And the market basically wrote it in with an 80% chance of certainty what was going to happen. It's a lot of uncertainty right now. These next two reports will dictate it, as Loretta Mester said. And yeah, there is some risk for that real estate firming up we're seeing. Though there's also the question of, is just matching last year's level of increases going to be enough to actually create any kind of renewed inflation of rent increases? Hopefully not, because obviously a lot of people are frustrated about how many rent increases there have been. And the last thing we need are more inflationary pressure. So we'll see. But that's some of the data on what's going on with the Fed today. Alrighty, so let's see here. Futures point to lower open. Yeah, we already know that. All right. Dude, Darby, man, it's okay to not know econ, man. I'm not trying to make you feel bad. I'm just saying what you're saying defies economic logic. Darby's back about T-Swizzle. He's arguing to Max. Who cares what the demand is for T-Swift? My point is T-Swift will sell. She has a cult following that would go into credit card debt and pay top dollar. Nobody's disputing that she has a cult following. Nobody is disputing that people will go into credit card debt and pay top dollar for Taylor Swift. In fact, that's what started the conversation. Nobody is disputing that. The economic argument is that there is a limit to the demand. There is a limit to how much people can pay. So you can't say, who cares what the demand is? Everybody cares what the demand is. That's the only thing that matters. That's literally what the entire market is about, is what demand is, supply and demand. C3AI shows zombie businesses still walking strong. Completely agree. Completely agree. Talk of pause and cuts correlate with inflation expectations. I don't know. I mean, inflation expectations right now at 5-year break even 2.14. No, that's interesting. I don't know. Ooh, that's an interesting question. If the Cybertruck has an exoskeleton, does that mean a simple fender bender could cause the vehicle to be totaled? Insurance will total a vehicle with any frame damage. Isn't this an issue? I have no idea. That would be a great question for Sandy, but I'm sure. See, Teslas don't get into accidents, so it's not a big deal. We got autopilot. What's an accident? I think that's actually a fair question, as the insurability of it. The good news is Tesla has its own insurance company. So yeah. All right, what else we got? All right, let's see here. Everyone's on commercial. Fine. Ha ha ha. Deeps thinks the Cybertruck is a terrible design. I don't know. I actually think it's kind of cool. It'll be really fascinating to see what the margins are on that thing too, once they scale it. All right, what else? Let's take a quick peek at the stickies. So L stickies are right here. The QQQ did a beautiful little bouncy bounce off of, I believe this is my Fibby here. Oh, 348. Yeah, 348 is one of my Fibbies. And it looks like it's done a perfect bouncy bounce in the pre-market off of the Fibby. You got Tesla sitting at, what are we at? 199.33. QQQ down 0.44. Everything pretty similar to where we left off yesterday. or even earlier this morning. Just slight little give back from yesterday. And yeah, German inflation falls more quickly than expected. Covered that. Falling French inflation boosts hopes. Actually, these kinds of articles will help lower inflation expectations from consumers. Think about it. You go to the top page here. It's Jamie Dimon warns against uncertainty. Loretta Mester sees no reason for a wait on rate increases. Meanwhile, German inflation falls more than expected. French inflation falls more than expected. Those are good things. So those will all help reduce some of those inflation expectations. All right, what do we got here?
Year ahead, it was get overweight, all things connected to this story. In China, the reopening, better economic growth, and then this happened. PMIs overnight, manufacturing 48.8, the estimate 49.5. Services holding in, but manufacturing disappointing. And as this dropped at about 9:30 Eastern time yesterday, this dropped too. The euro dollar breaking down to about 106.85 on the screen right now, negative by 0.5%. And some measures, some Chinese indexes, equity markets, showing the equity market in China in a bear market. Mike McKee, that's not the way this year was meant to go.
It is not the way this year was meant to go. And there's a lot of things going on. Jamie Dimon maybe underscored it when he talked about uncertainty, because there is the international diplomatic effort by the United States to sort of isolate China technologically. And there is also the Chinese effort to clamp down on its own economy and to become more centrally planned. And you can see what's happened, John was just talking about, with those PMIs, especially manufacturing, falling far short. Now, the hope was that a lot of people would spend money coming out of the pandemic in China, and we did see an initial pop in services, but those have rolled over as well. And overall, what you're seeing is a decline in what they think is going to happen. The country put off...
Honestly, the GDP is probably going to come in even softer. It's mostly because what's propping it up right now is this idea that at the beginning of the year, everybody went crazy on services spend, but that pent-up demand could fade, and then what? Well, then your 5% GDP goes out the window as well.
In the high sixes. So China definitely slowing down. That's having an impact on the world now. We are seeing demand fall for imports into China, particularly for commodities, which could have a big impact in the United States and Europe in terms of inflation. You can see there what's happening with the metals for copper and for iron ore.
Straight down your production metals.
Chinese demand drops. And so we are looking, John, at a situation that is going to have different impacts on the global economy, maybe bring down inflation, but also maybe bring down growth a little bit.
Mike McKee, thank you, sir. Please, you brought up commodities, 68 on WTI. Thank you, Mike. We're down by about 1.6% this morning.
Oil down. Nice. Okay, very well. So I'm going to make another cup of coffee. See you in the course member live stream. If you have not yet joined the fundamental analysis groups in the course member live streams, check it out. We can see you there in 7 minutes or so. And check out any of the programs. They all come with lifetime access to course member live streams at this point. And love to see you there. Thanks so much. Join before that price increases on June 1st, which is just in about 36 hours. And we'll see you in the next one. Good luck and goodbye. And if you have any questions, email us at staff@meetkevin.com. We could bundle you up if you've already got a course, you want another one, you want to get the best price on joining multiple courses, email us at staff@meetkevin.com. Or if you just got questions, again, staff@meetkevin.com.